This is the Alt Thinking Podcast by 9 Point Partners. Today, featuring the DeFi Decoded series in partnership with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, everybody, and welcome to this week's edition of DeFi Decoded. I'm Alex here with co-host Andrew Young, and today we are talking about insurance. I know that sort of sounds like a sleepy subject, but it's an area where there is a ton of innovation going on today, and it happens to also be one of the biggest parts of the entire financial industry. In fact, insurance and risk management is a $6 trillion market worldwide, and so far, it's been underrepresented in the DeFi space. Decentralized insurance platforms and prediction markets enable the trading of so-called event risk between participants. So if you think about that in an insurance context, there is an event that happens at the end of everybody's life. It's called death. And insurance policies for life insurance pay out when that occurs, right? So a lot of insurance policies are based on the idea of a so-called event that has risk associated with it. These DeFi platforms have upended the traditional model by basically allowing anyone to transact with each other through smart contracts with no intermediaries like insurance companies in the case of traditional insurance like life insurance, or investment banks and other financial intermediaries in the case of the derivatives market. None of those guys sit in the middle. So we've seen DeFi protocols like Uniswap and Aave tackle and disrupt markets like trading and lending. And the question now is, will decentralized insurance see the same kind of growth? And what kind of impact will these emerging decentralized models for insurance have on legacy institutions and business models, if any? So in this episode of DeFi Decoded, Andrew and I are going to really just dig into insurance and prediction markets and discuss how these platforms could have the power really to transform risk management. And it's a good topic to be discussing this with Andrew because Andrew's actually built I guess, I don't know, his day job or his other job, one of the largest DeFi prediction market protocols in the world, the SX network. So he's actually someone who isn't just a pundit like me, someone who's actually built something in this space and is uniquely positioned to answer some of these questions. So Andrew, let's dig into it.
Perfect. Looking forward to it.
All right. So what is an insurance protocol and what is a decentralized prediction market? Let's start with that.
Yeah, I think we're doing a good job here in terms of bucketing the two together because in terms of their actual implementation, so far they seem to be quite similar. So for the most part, insurance protocols are essentially peer-to-contract DeFi protocols that allow people to take out insurance, typically against hacking risk of other DeFi protocols. So what I mean by that is, in the case of something like NexusMutual, which is the biggest DeFi insurance protocol, it allows users to essentially buy protection against their other DeFi positions. So for example, if I'm a big lender on Compound, which is obviously a lending protocol we covered earlier, and say I have $10 million in the Compound smart contracts earning a yield, I can go to NexusMutual to essentially buy insurance against that position. So if the Compound smart contract gets hacked, I can then go and file a claim on NexusMutual for the amount that I have covered.
And is that a policy that you own, or is that like an asset that you buy that can be traded? Is it like an insurance policy, or is it like a credit default swap, right? That is like an asset.
Yeah, and so that's really, and that question actually illustrates the difference between kind of insurance protocols and prediction markets.
Okay.
An insurance protocol, that position typically is not tradable, and it's structured more like what you're saying, which is kind of an insurance policy. On a prediction market, so prediction markets, so people are aware, they're a peer-to-peer exchange for trading event risk, and those are typically structured more, like you said, a credit default swap. In this case, they're typically structured as a credit event binary option.
Okay. Maybe you want to break that down word by word for our audience.
Yeah, exactly. So credit event binary options, kind of an exotic type of option that exists in the traditional financial world. Mm-hmm. And essentially what it means, it's essentially like a credit default swap in the sense that there's a credit event, which could be a bankruptcy of some sort of third-party entity. but the coverage is the payoff in the event of a credit event is all or nothing. So that's why it's a binary option. So the payout is essentially 0 or 1.
Right.
There's no kind of I guess I don't know how to explain it, but like there's no
partial payout or
yeah.
partial claim or something like that. Right?
Exactly.
Yeah.
And prediction markets actually have a lot of uses beyond just insurance, but I think these two products sort of work hand in hand, and they're kind of the main ways people trade event risk in the DeFi.
Yeah. Yeah, I mean the idea of buying insurance against the default of, what an effect is the default of, a financial entity. It's in this case, it's a smart contract versus say like a bank. Is something that has a long legacy in traditional financial markets. I mean, credit default, that's what a credit default swap is, right? It's insurance on bonds that you own. And if the underlying entity can't pay the bond back, then you get paid back and compensated from the swap. And obviously it was used for a variety of crazier, more esoteric things down the road. But the fundamental kernel of what a CDS is actually just a form of simple insurance. So I think if anybody who's listening to this is coming at this from the credit markets or even just financial services generally, I think you'll kind of innately understand that. You said something that was really interesting, which is it's not a peer-to-peer insurance, it's a peer-to-protocol, right? Or a peer-to-contract. And I think that's sort of interesting. That's something that's popped up before. We've talked about that in a trading context and a lending context. So the protocol is really key here. How does it work?
Yeah, so again, there's like all these different DeFi protocols. There's different structures for how they can kind of exist. So in the case of NexusMutual, it is peer-to-protocol. So what I mean by that is when your counterparty when you're buying insurance is actually a smart contract. It's not another participant. Mm-hmm. And that smart contract, the way it sort of works is people stake tokens to provide liquidity to that smart contract. And then in NexusMutual, the token is called NXM, and that provides the liquidity to sort of backstop these insurance contracts from the buyers, from the buyer side. And what's interesting about that is it sort of allows the protocol, because these risks are should be to a certain extent uncorrelated with each other, these different insurance policies. Yeah. It allows them to, in a way, get leverage on the liquidity. What I mean by that is you can kind of have a certain amount of liquidity provided and a different amount of insurance contracts taken out on the other side. Prediction markets are actually different. Prediction markets are fully collateralized, and typically they're peer-to-peer. At least that's the main method at this moment.
Right.
So they resemble kind of the more traditional swap market or betting markets, as people sort of know them, in the sense that there's the other counterparty is actually another market participant directly. Right. And the protocol just facilitates that trading in kind of a trustless and non-custodial and decentralized fashion.
So going back to the insurance protocol for a second, you mentioned that the primary use is to insure against effectively default risk or hacking risk of the other protocols that someone might be using. Does that mean that the premiums are different? I mean, a house that's in a floodplain will have higher insurance premiums than one that's on higher ground, right? Because there's greater risk. And would the same thing apply for these different protocols? Are there certain ones that are viewed as being perceived as being higher risk than others? And does that affect the way that the insurance is priced?
Yeah, exactly. So it's the insurance is priced very similar in terms of market demand, supply and demand. But obviously the market demands a higher premium for projects that there's kind of two factors that go into it. So the first is length, that the smart contracts have already been out in the wild. Yeah. So because that essentially every day that a smart contract is live in production and holds millions of dollars, you can kind of see it as almost like a competitive bug bounty, right? Because it serves as a big target for hackers. And so essentially every day that it survives is adds to the stability, or I guess perceived security of those protocols, just because there's always an incentive for people to hack them.
There's an expression, right? What that's called the Lindy Effect,
Yeah.
basically. Like the longer that something exists, the more likely it is to continue to exist for a longer period of time, right? So, I mean, this is a perfect example of the Lindy Effect in practice.
Yeah, exactly. And you can also kind of chart it in terms of also the amount of money held in the contracts, because if there's only $100,000 in the contracts, then actually hasn't really been battle tested, even if it's been around for a long time.
Right.
Just hasn't been as much of an incentive. And then the second thing is also just track record. So certain protocols, like early in the days of NexusMutual, for example, certain protocols that had already been hacked a couple times. So the good example would be BZX, which had been hacked a couple times, sort of successively. They had much higher premiums, like 40-50% annualized premiums, whereas something like Compound was more in like the 4 to 5% range. And
which is interesting because, even 4 to 5% still huge in the context of traditional insurance, or even traditional like CDS swap rates. I mean, that's a lot to pay for the risk of default. So I guess if the market really is pricing this, the market's still saying even Compound, battle tested as it is and large as it is still, pretty high credit risk, right?
so the interesting thing about that, and there's kind of two reasons why. First is just simply the extremely high cost of capital in crypto.
Right.
It's very tough to get people to kind of put their capital to work and only earn kind of a sub 10%, sub double-digit return.
Yeah.
And then the second factor, which is kind of interesting, is you're putting your money into a smart contract, and that smart contract also has risk. So if you think about it, you're putting your money into a smart contract to sort of insure against another smart contract.
Right.
That actually historically, there's actually been a couple cases, or I guess there's been one very prominent case with this insurance protocol called Cover Protocol.
Yeah.
Which itself was actually hacked. And so people who were providing liquidity to Cover Protocol to insure against other assets, those assets were actually hacked as well. So, and we don't need to get into kind of the specifics of it, but it's kind of interesting because, yeah, I mean, you can't really, if you're operating in DeFi, you're sort of transferring one protocol risk for another. And so, yeah, you can't really ever, I guess it's kind of like the financial market. You can never really escape counterparty risk. You're just transferring it from one person to the other.
Yeah, it's just the exact same as the way the financial markets work, and used to work for everybody until deposit insurance was created for the little guy, right? Which is that in the end, in the States and Canada where we are, if everything goes belly up, the government will make you whole as a depositor up to, whatever, 200 grand or something like that. But there is no government bailout in crypto. It is really more akin to the Wild West days, I guess, of what the financial markets were like, in the early parts of the 20th century. But just not just on steroids, and with these incredible technology tools. So this that sort of anticipates sort of the next question, which is, what's the adoption been like, and has it gone mainstream? And if not, why do you think that is?
Yeah, it's good. Good question. I think the insurance and prediction market protocols, they've sort of seen some usage, but it's definitely been kind of lagging other areas of DeFi like lending and trading. The biggest insurance protocol in the world, NexusMutual, for example, has $500 million of TVL in it, which is definitely pretty substantial, but pales in comparison to something like Aave, which has 15 billion.
Yeah.
And so it's kind of an emerging area of DeFi. And then I guess I would just say a quick thing on prediction markets. Prediction markets up until very recently, they've been hampered by the high transaction costs and network costs of these different, for example, Ethereum, where DeFi has essentially existed up until now. And the reason why is because the average transaction size of a prediction market trade is much lower than the average transaction size of a lending transaction. And so it's disproportionately hurt by higher fees.
Mhm.
And that's rapidly changing though now with kind of the rise of Polygon and these alternative layer 2 networks.
Yeah. So we've talked a lot about insurance protocols, but I think it'd be important to talk a little bit about the decentralized prediction market space. So with prediction markets, what are they being used for today? And what do you think they can be used for in the future?
Yeah, it's a great question. I think there's three main areas where prediction markets can get a lot of adoption. The first is the one we sort of talked about, which is for ensuring different specific risks within the crypto markets.
Yeah.
And I think they definitely have a role to play there, though I do think that insurance protocols are maybe better suited for them. The second is for price speculation and risk management. So you can use prediction markets to actually trade the price risk of different cryptos and crypto assets.
Mhm.
And then finally, the third category, which is actually gaining the most adoption in the short term, is what I would call entertainment markets. So this is essentially prediction markets on sports, politics, pop culture, things like that. And so those types of markets are or already exist in the traditional world, but they're kind of classified as betting exchanges and stuff like that. And prediction markets are effectively betting exchanges at the end of the day. And so that's kind of an area that's actually had the most adoption with projects like SX Protocol that I'm a part of, and things like Polymarket that have already done tens of millions of dollars in transactions there. Which is still small compared to the overall DeFi market in terms of trading volumes and lending, but rapidly growing. And then finally, those are kind of the three main areas. There's one area that is sort of a hypothetical area that prediction markets can help with, and at this point haven't had any adoption, but is something that I'm focusing a lot, which is this idea of governance markets.
Why don't you talk a little bit about that? Because I think that's an area that probably people would like to understand a lot more.
Yes, exactly. So, so that's what we're actually focusing on at SX Network. So SX Network, just as a brief background, is a EVM compatible blockchain built using the Polygon SDK.
Hold on. So EVM, Ethereum virtual machine. Just explain what that is briefly. And and SDK.
Yeah, SDK software development kit. Essentially, EVM is just Ethereum virtual machine. So it essentially allows any applications that are built on Ethereum to easily deploy there onto SX Network.
Right.
Pretty much every non-Ethereum blockchain at this point has EVM compatibility, just because that's where all the developer mindshare and tooling is.
Right.
Using Polygon. So Polygon, like I mentioned, is the largest layer 2 network in the world.
Yeah.
And they have their own blockchain, but they also kind of have a suite of different scaling solutions. And one of their scaling solutions is this thing called Polygon SDK, which allows you to launch your own standalone blockchain, sort of using their architecture and software. And so by using Polygon SDK, it allows us to sort of spin up a secure and highly scalable blockchain with kind of the backing of one of the biggest layer 2 blockchains in the world. And we're doing this in conjunction with them, working hand in hand.
So for something like SX Network, okay, so you've got all the apps, all the dApps, I should say, in DeFi are on Ethereum today. Most of the big ones. But it's slow, so Polygon layer 2 helps to speed them up, but also acts as bridge to connect to SX, which is a protocol that is better for prediction markets. Why is that? Like, what is unique about SX that works for this specific vertical that we're talking about versus, say, any of the others?
Yeah, so where SX Network is different is the biggest, I guess, unknown or challenge right now in the crypto and DeFi ecosystem is this idea of decentralized governance. So governance is essentially, it's the same as governance in the normal world, which is how are these blockchains sort of changed and adapted over time to iterate with all the different challenges and things that come up. So different networks like Bitcoin, for example, minimize governance. There's almost no changes to Bitcoin at all because there's no real, I guess, set process for instituting changes. DeFi protocols need to be more adaptive to market environments. And so they have these things called governance systems, which typically the token, it represents voting in the governance system, and it allows the projects to make collective decisions on parameter changes, funding decisions, and things like that. So the thing, what happens though, you can sort of think of governance as like shareholder voting in kind of a way.
Yeah. I mean, that's what I think most people think of, right? It's like, we got to approve some big change, appointment of a board member, a takeover of a company, a big financing. Okay, we got to put it to the shareholders and get their view on whether it's a good idea, right? Like, that's in corporate governance, that's what people think of.
Exactly. And so the problem that's sort of arisen is that people are increasingly finding that this one token, one vote sort of traditional model that everyone's applying for these governance systems has been leading to massive voter apathy. So most holders don't feel incentivized to actually participate in governance, particularly holders with less, like, that aren't considered whales, that don't have a large token allocation. And so you get these systems where 20 people are voting on these essentially billion-dollar decisions, and the vast majority of people are not participating, which is not ideal in any way.
When you say 20 people, just so I understand, it's not like they've got 20 tokens out of a billion. Those 20 people could be 20 whales, right? Like 20 large holders that therefore have like outsized influence. And that, combined with the fact that all the smaller holders aren't participating, leads to those big guys running the show, right? Is that basically what you mean?
Yeah, exactly. So, okay. And those holders may sometimes don't even represent that big of a percentage of the total supply. So, like, for example, something like MakerDAO, they'll have votes passed that are critical, and only less than 10% of the total tokens will actually even vote in the process.
I think that might even be lower than shareholder proxies. So what do prediction markets have to do with any of this?
So prediction markets, one of the biggest use cases of prediction markets that's sort of been thought of is this idea of futurarchy, which essentially what it means is you replace a voting system with a betting system. So instead of having people vote on major governance decisions, you would actually create a prediction market on the governance decision and have people essentially trade the policy that they think is best. So essentially, if a policy had a higher market price because people thought it was better suited to achieve the stated policy outcome, then essentially the policy with the highest market price would be chosen, and then the people who had essentially bet on that policy to be the best policy would be locked into a position where essentially they would win if the policy actually achieves the outcome, or they would lose their bet if it didn't. And so it's trying to replace the traditional sort of voting system with a market-based system, where essentially people bet instead of vote.
And this would lead to higher participation. Why exactly? Is it because people like to wager on stuff, and so it sort of gamifies the process, or is there some kind of penalty if you don't participate? Like, why will this therefore lead to greater participation in governance?
Yeah, it's a great question. The biggest is that you create this profit incentive for people to actually participate in governance, and you can actually combine it with protocol incentives as well. So like the traditional kind of liquidity mining incentives that a lot of these DeFi protocols do, and essentially allows people, it's really just the age-old trader incentive. If you're a good trader, you will benefit financially through this system. And by doing so, though, the people who are, I guess, quote unquote, deciding these outcomes for these systems, they have skin in the game. Because if the policies don't achieve the stated outcomes, then they lose their stake. And so they get to gain from good policy decisions, and they also stand to lose from bad policy decisions.
Right. So it's interesting. I mean, we're kind of a little far afield from insurance, but I think what the important thing here is that prediction markets can be used as a very powerful tool to do a variety of different things, right? This isn't just about, I think when people think of prediction markets, they think of wagers, right? There are a lot of prediction markets around politics, for example, like, will Biden, hold on to the Senate in the midterms or something like that. But actually, there's all sorts of use cases in insurance markets. Will this crop fail? Maybe somebody wants to take the long on that position if they're a farmer because it pays out and their crop fails, so they're hedged or something like that, or life insurance or whatever. But then even beyond that, the idea of using prediction markets and really like market mechanisms in general to try and encourage desired behavior, right? In systems, whether it's, in insurance markets or in something else like governance. So, this is all pretty out there at this point in time, but, people react to incentives. That's the sort of cardinal rule of economics. So, it stands to reason that this could actually work. This is a really interesting discussion. We're definitely on the bleeding edge of DeFi at this point in time. We started with the bread. It's funny to talk about the bread and butter or the mainstream DeFi application. Sort of feels like an oxymoron, but there obviously are some areas where this has grown a lot. These are some of the more exciting, more cutting edge areas. Pretty soon, we're going to transition to a different format where from time to time, we're going to be interviewing people who are actually building these protocols to really dig in deep and talk about their experiences and what they see as the future as well. So there's lots more to come from DeFi Decoded, but that's it for today. Thank you very much. I'm Alex with Andrew. Have a great day and we'll see you next week. Take care, everyone.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.